Today, we are going to take up another very important topic on peer review, that is compliance with accounting standards for practicing unit. What are the accounting standards that a practice unit has to follow? This part I have divided into three parts, and I am going to take up the first part. And this portion has been divided, that is technical, professional, ethical standards compliance, divided into four parts. One is accounting standard, second one is standards issued by ICA and frameworks issued by ICA and its applicable provisions of various statutes or regulations. Each and everything that we have to cover in detail. Now we have to check today. We are going to see the accounting standards. It's a sample checklist. This I have taken from our Institute peer review manual, and from this we are going to have discussion, and for detailed study please refer our ICA manual. AS1, that is disclosure of accounting policies, because a practice unit has to follow whether the company or client they followed the accounting principles correctly or not, whether all the significant accounting policies have been disclosed at one place and as a part of the financial statements. That means the accounting policies have to, what are the accounting policies that the company has followed, that you have to, the practice unit has to see, and what are the financial statements they prepared based on the accounting policies. That is, here accounting policies are the specific principles and procedures implemented by a company's management team that are used to prepare the financial statements. These include any accounting methods, measurement systems, and procedures for presenting disclosure. They say that any accounting methods. What are the accounting methods? That you know it, but here the main thing is AS1 is disclosure of accounting policy, whether the company is following the accounting policies correctly at the time of preparation of the financial statements, that a practice unit has to check. Next standard. Before going to the next standard, we have to see the disclosure accounting policy. If there is any change in the accounting policy, that is when compared to the last year, if there is any change in the accounting policies, that has to be disclosed separately. And what is the impact on that change in accounting policy in the financial statements, and whether the practice unit has to see what is the quantification of its impact on the financial statements with reference to change in accounting policies. And whether the fundamental accounting assumptions, that is whether it's a going concern or consistency or accrual, have been followed. These things the practice unit has to see whether that means fundamental accounting assumptions have to be followed correctly. One, accounting policies, and if there is any change, that has to be recovered, that has to be disclosed separately. And what are the fundamental accounting assumptions, that also a practice unit has to check with reference to peer review. If it is not that, then all the facts have to be disclosed separately. What are the kinds of accounting principles? That is accrual concept, conservatism principle, consistency principle, cost principle, economic entity principles, full disclosure principle, going concern principle, and matching principle. Everything have to be followed in the accounting standards. That is AS1 with reference to disclosure of accounting policy. Next one is AS2, valuation of inventories. It's a very, very important area, because inventory valuation plays a very, very vital role. It plays a very vital role in arriving at the true and fair, that is true and fair of profit correctly. Even it is useful at the time of getting the loan from banks. Even in the income tax also, they are giving utmost importance to the inventories, whether the customer, whether the company has followed the valuation of inventories correctly or not, whether the proper registers have been maintained. Everything has to be checked by the practice unit. This is being specifically covered in AS2. That is, check whether the accounting policies adopted in measuring the inventories include the cost formula used have been disclosed. How they have arrived at the inventory valuation have to be clearly maintained by the company, and the practice unit they have to verify at the time of doing the audit. What is the method of valuation? Whether they value the inventories at the lower of cost or net realized value. That is sale or market price. Sale or market price or cost or actual cost or net realized value, whichever is less, whether they are following it. In turn, we have to see whether the company that is valuation of inventories policy, whether the company has followed it properly or not. What is the method of valuation? Everything has to be clearly spelled out in the register. Those registers have to be verified by the practice unit. Does the financial statement disclose the following? That is, in the financial statements, the valuation of inventory has to be disclosed properly. That is, the accounting policies adopted in measuring the inventories, which includes the cost formula, that is FIFO method, first in first out method, and the total carrying amount of inventories and the classification appropriate to the enterprise. So what is the method of valuation that the company is being they are following at the time of valuation of inventories, and what is the value of the inventories that has to be clearly spelled out in the financial statements of the company. And the valuation of inventories is a very, very important thing, though it's only a checklist. But as an auditor, as a practice unit, you can go depth into the transaction, whatever be the qualification you have to give, because it's maintaining the working paper is very, very important area, and every practice unit has to maintain the records properly, and the basis on which the company has adopted the valuation, and whether you agree or not, everything has to be disclosed properly. It's only a guidance. So apart from this, you can add anything. So it's a cash flow statement. It's a must for each and every company. They have to prepare the cash flow statement, where the fund comes and what is the source, whether it's a long-term funds or short-term funds, the purpose for which they are going to use it, whether it's for buying the fixed assets, to meet the working capital, or for the purpose of investment. Everything has to be clearly spelled out in the cash flow statement. This is being covered in AS3. Is ensure that a cash flow statement of the current year is prepared. Cash flows are classified as operating. That is for regular operation. What is a cash flow? What is the source of business? That is whether it's in the form of sales, and where they part, whether it's in form of purchases and other expenditure. Everything has to be clearly spelled out in the cash flow statement, and whether the money has been invested towards investment. Whether the money has been invested properly, and what is the financing activity, whether what is the interest rate that you are paid, from where you have raised the fund, and what's the mode of repayment. Everything has to be clearly spelled out in cash flow statement. And being a chartered accountant of the practice unit, you are very well thorough with the cash flow statements, and whether the enterprise has reported the cash flows from operating activities using direct and indirect method. So that means the practice unit has to see whether the cash flow process has been properly scrutinized. That is a specific thing that the peer review they wanted from the practice unit, and whether the cash flow from transactions in foreign currency. So that means in the Indian currency, what is the inflow? What is the foreign inflow from the foreign currency recorded by applying the foreign currency amount, the exchange rate between the reporting currency and foreign currency at the date of the flow. Here they use the word reporting currency. Reporting currency here it is Indian rupee. Suppose if you are preparing cash flow statement on particular day, what is the rate of that foreign currency? That is when you have to convert the amount into Indian rupees, because everything is being valued in India in Indian rupee. Suppose what is the $1 rate? So that is you have to follow the direct method of valuation, direct quotation of valuation, That is $1. Suppose the $1 is 83 rupees, and due to change in policy, the rate may fluctuate. So it is there in the direct quote method. So what is the rate that is there on the date of preparing the cash flow, that that has to be clearly spelled out in the cash flow statement. A rate that approximates the actual rate may be used if the result is substantially same as would rise if the rate or the dates of cash flow were used. Simple, very, very simple. if the cash flow can come in Indian rupee, cash flow can also come from the foreign currency. If you are bringing the money in foreign currency, the date of conversion, that is the date of preparing the cash flow, what is the rate available that you have to convert. Say, suppose if it's $1,000, they are coming today, if it is 83 rupees, 83,000 rupees is the inflow, but here they have to put that is inflow of foreign currency. And suppose in case if you invest also, if you divert the funds, if you send the funds, then that also you have to clearly mention the cash flow statement and check whether the cash flow associated with the then extraordinary items being classified as arising from operating, investing, and financing activity as appropriate separately disclosed. Suppose if there is any extraordinary item, suddenly if you are going to buy an suddenly one asset, or suppose we are making any compensation, everything has to be specifically mentioned in the cash flow statement. This is clearly stated in the AS 3. Also, you have to exclude the non-cash item from the cash flow statement, because cash flow statement comprises only of cash and bank, non-cash items. So non-cash items you have to exclude from the cash flow statement, and if it is included, then the practice unit has to separately report yes, non-cash item of this sum to this extent, non-cash item. So just like goodwill, just like depreciation, everything is being included in the cash flow statement. That has to be separately reported, but that will not form part of the cash flow statement, that you have to exclude it. And now we are going for contingencies and events occurring after the balance sheet. So that is a clear indication that the practice unit has to see there is any contingency, and if any events have occurred after the data balance sheet, whether it has got a direct effect on the financial statement, whether it has got direct effect on the company, that has to be separately reported. This is being covered in AS4. For example, if any, with reference to bank, we can say in case of bank, if NPA account, that is non-performing assets account, if the party has come and regularized the account after the data balance sheet, but before completing your audit, that has to be reported. So contingency may be anything, any event may occur after the balance sheet, but that has got direct impact on the financial statement of this current year. So that also you have to report it separately. So here, whether the contingencies mentioned below have been taken into consideration, they are saying that with reference to warranties and clients, is there any disputed tax, excise, or other taxes and duties, claims against the company not acknowledged as book debts, bills discounted? So these are the contingencies. Suppose in case the income tax dispute is there and you have gone for appeal, the appeal may come this way or that way. It's only contingency liability. Suppose if it is favorable, then the company is not losing anything, and if it is not favorable, then company is losing. So all these kinds of contingency, the practice unit has to see and cover in his report. Next thing is, have the assets and liabilities been adjusted for events occurring after the data balance sheet that provide additional evidence to assess the estimation of the amounts relating to conditions existing at the balance sheet date. So any assets and liabilities, now only invoice has come, asset has not come. Sometimes asset has come, but invoice has not come. So they would have passed a journal entry by clearly mentioning that the events occurred after the data balance sheet, but this event, this transaction pertains to the current year. But based on the situation, you can decide. So this point also you have to cover in AS4 contingencies and check whether it is ensured that no contingent gain have been recognized in the financial. So say contingent loss also you should not include in your financial statement. Contingent gain, that should not be forming part of the financial statement. That means any contingency gain you should not include in the financial statement. As a practicing unit, you have to see whether those types of contingent gains have been included in the financial statement. And thus any event after the balance sheet date indicates that the fundamental accounting assumption of going concern is not appropriate. If so, assets and liabilities being adjusted. So fundamental accounting assumptions of going concern have to be seen by the practicing unit, and if it has got anything which is not appropriate, that you have to specifically report in your AS4. And AS5, that is net profit or loss for the period prior items and changes in accounting policy. That is, if any last year expenditure, last year profit comes in this year, that is, prior period item has been entered in the financial statement of the current year. As a practicing unit, you have to see whether those type of things have been included or not. You have to be specifically, mentioned in your report that those items have got direct impact on the profit, or the prior period income and expenditures disclosed separately in the profit and loss account in a manner that their impact on the current profit or loss is perceived clearly. So it's a clear thing that the practice unit has to see whether the company has included the prior period income, prior period expenditure, and they pass the entry in the current year, and they have to separately mention in the financial statements. If that is clearly mentioned, then the practice unit has to give the direct impact on the profit or loss in the based on the profit and loss account scrutiny. And has there been any extraordinary event occurring during the reporting period? Is it disclosed separately in the profit and loss account so as to understand its impact? What is it? It's nothing but so any extraordinary event occurring. So in case fire has taken place, but you may insure the transaction, you may not insure the transaction. If you insure the transaction, okay, if it is fine. But due to some fire, due to some software failure, due to rain, due to flood, some extraordinary event has occurred, and suddenly there is a change of accounting policy. So there is a change in government policy. Everything has got direct impact on the profit and loss account of the company. So as a practice unit, you have to give observation. You have to see whether it has got a direct impact on the profit or not. So practice unit has to take note of it at the time of verification. Then is there any change in the accounting estimate which has material impact either in the current period or in the future period? That is the estimation. You can say that today I produced 100 rupees and next year I will produce 1000 units. It is not possible. And if they say that they produce 1000 units, then the company has to prove that the estimation prepared by the company is correct. And for that, they have to say that, sir, we have installed additional machinery, we have got the additional orders and everything they have to prove. So the change in accounting estimate, every year we will produce 100 units. Okay, that is the standard policy. Suddenly this year 100, next year 500, and subsequent year it is 1000, 1500. So the basis of calculating the estimation has to be explained properly and has to be verified by the practice unit. The company has followed the same or not. Is there any change in accounting estimate which has material in financial impact either in the current period or in the future period? Is there any change in the accounting policy? So that is also, suppose if there is any change in policy. Suppose if you are deputing some 50 staff, then that will increase the cost. And if you depute 50 staff, that additionally, in addition to last year, then what is the turnover ratio? Whether that will increase the total profit or not? Everything has to be clearly spelled out. So this is clearly stated in AS5 net profit. And last thing, if yes, then what is the material impact is disclosed in the financial. Very, very simple. If there is any materiality decision, materiality event, and whether it has got a direct impact on the profit or not, that has to be clearly verified by the practice unit. Now we are going for the construction contracts. What are the types of constructions that the unit is carrying out or the company is carrying out? Whether they are, if they are builders, whether they are the real estate builders, whether they are constructing the office, whether they are constructing the building for the purpose of sale, whether they are constructing the building for the purpose of self-occupation, whether they are constructing the building, whether they are constructing the work based on the their own direct supervision or through contractors or through engineers, and what are the contracts entered in between the company and the engineer. Everything has to be verified by the practice unit, and everything, whether all the conditions of the construction contracts have been properly incorporated, whether the conditions quoted in the construction contracts affect the company or not. See, as a practice unit, as a chartered accountant, you have to see, you have to read the construction contracts also. It is only highlight I am giving, but even you can go beyond the suggestion given by the mentioned. That's the same method of accounting, that is percentage of completion method or completed contract method, been used for all construction contracts that make a similar thing. So what is the method of accounting that they are following at the time of construction of any building? That is the construction account you have to see. That's a profit in case of fixed price contracts being recognized only when the work has been progressed to a reasonable extent. That is, they can transfer the profit from the construction work to the company's P&L account, provided only when a reasonable portion of the building contract is over. The enterprise has disclosed the following assets in the construction contract, that is gross amount due from the customers for contract work as another. Here also I want to tell one thing. Now all the construction of thing with reference to real estate concept is being followed and controlled by RERA, Real Estate Regulatory Authority. You have to be master in RERA also. So this is one thing. And there's a construction work the company is carrying. What is the gross amount due? What is the amount actually received? What is the amount pending? Everything that practicing unit has to see. What is the amount due to the customer? Sometimes the customer has to pay. Sometimes this contractor would have received the amount. That is, this company would have received the amount in advance. Whether after the completion of the work, if any surplus is left, you have to return that to the company. So gross amount due from customers, gross amount due to the customers have to be disclosed properly, and everything has to be seen by the practice unit. Whether the enterprise has disclosed any contingency in accordance with AS 29 provisions, contingent liabilities and contingencies, that is any warranty costs, penalties and possible classes. What is warranty? The warranty cost, suppose if I am not able to complete the thing within this, that is if I have completed the building, but due to some quality, if there is any deficit in services, then the company has to reimburse it. So that is also another contingency contract. Contingency is there on the part of the company. Next one is penalty. Suppose if the building is not being completed on time, then that has to be offset by the company. That is, everything is there in the construction contract. And what is the possible loss? Possible loss means maybe due to some change in government policy, maybe due to some increase in raw material costs. All this have to be given provision in contingent liabilities and the contingent asset. So this is as a practice unit, you have to follow all this AS7. And once again, I want to tell, even you can go beyond this. It's only a suggestion. It's only a suggestion. Even you can go beyond the points mentioned in the AS7. Now we are moving to AS9, that is revenue recognition. So have you ensured that revenue is recognized only when there is a certainty to its collection? Only when it is possible to collect the amount, whether the revenue is being entered properly. That is, when you pass the entry, just like say rent account data to that is rent receivable account data to rent. That is, it's a possible that you will receive the amount. Because in case it is when it's not possible for you to collect the amount, or even if you are not assured of collection, that you are not supposed to take into the revenue recognition. So the point number one is, have you ensured that revenue is recognized only when there is a certainty to its collection? Second, check whether the revenue from sale has been recognized properly only when the following conditions are satisfied. That is, the property in the goods has been transferred for a price. Property in the goods has been transferred for a price, or all significant risks and rewards of the ownership have been transferred to the buyer, and the seller retains no effective control of the goods to a degree usually associated with ownership. So ownership, that's a sale, there is a buyer. So if there is a sale and the ownership goes to the buyer, the controls have gone to the buyer and seller has got no control. So if that is fulfilled, then sale is there. If it is not there, then ownership is not transferred. The seller himself has retained the control, that the sale is not completed. So that point, as a practice unit, you have to see whether, suppose if there is any sale, that sale agreement or sale deed you have to verify. There exists no significant uncertainty regarding the amount of consideration derived from the sale. What is the total amount of? It's nothing but what is the total amount of sale. Whether all the amounts quoted in the documents have been received by the company or not. That also, as a practicing unit, we have to verify whether those amounts have been recovered, have been shown in the accounts, have been entered in the accounts or not. That you have to give, practice unit has to give specifically the effect of receipt of money. If it is not reasonable, that is, if it is reasonable to expect ultimate collection of the consideration, when you are going to collect the amount, that you have to specifically see whether is there any chance for the collection. So in revenue recognition concept, one thing you have to see whether the money is actually received, is there any possibility of recovery, or if there is any deficit, you are not supposed to include the same thing in revenue recognition as per IS 9. And another points in AS 9 is, have you ensured the following in the performance of the rendering the service? That means you are giving service. So whether it's possible to complete your work on time, whether the same thing is included in the contract, and whether you are performing the job as per the contract, whether there's a possibility of recovering the money, recovering the money correctly or not. So there is no significant uncertainty regarding the amount of consideration. So you have entered the contract, but if you are not assured of the consideration, what is the service charges, what is the cost that if you are not able to analyze, then the same thing has to be seen by the practice unit. Whether the revenue arising from royalty, interest, and dividend is recognized when there is no significant uncertainty as to the measurability or correctivity. Whether that is, you don't know the exact date of royalty, interest, and dividend. If it is assured, then the same thing can be included in the in your profit and loss account certificate, AS 9 revenue recognition. And if there is uncertainty, then that should not be included. And check whether there is a provision has been made to reflect uncertainty, where uncertainty relating to collectivity areas subsequent to the recognition. So you have performed the job, you are not able to recover the money, so you have to give some provisions, or even say that this I have entered this job. Suppose I have entered into one job work. I have even beyond the job or contract, I have done some additional work. I am not assured of the work. I am not assured of the money, but I have completed the work. The possibility of recovering the services, that is income, is not assured. So that you have to you have to report separately, and as a practicing unit, you have to see whether those type of income recognition, that is revenue recognition, is there in the account by the party. With reference to property, plant, and equipment, so what are the important? It's a very simple. So first thing that you have to see whether there is a fixed asset register, whether all the fixed assets have been properly numbered, and the location of the fixed asset register, fixed assets, and when they are purchased, whether proper depreciations have been put on the fixed assets, and who is having the control of the fixed assets, whether the fixed asset registers have been updated, and whether those fixed assets are capable of we can say sale eligibility. Whether, suppose in case if in future if you are selling any fixed asset, is there any sale value in the thing? But only one very important thing in the practice unit that you have to, that as a practice unit you have to see, you have to see whether the company is having the fixed assets register, and that too with updation, and have the standby equipment and servicing equipment being capitalized. So standby, it is not your thing, it's only temporary thing, it should not be capitalized. Whether if that has been capitalized the account, that also you have to see. So this property belongs to someone, this is only standby, this can be destroyed at any time, so this should not be included in the asset. So all this practice unit has to see. Sometimes the company would have capitalized, but as a practicing unit, you have to see whether those type of items have been capitalized or not. Check whether the following included in the cost of the assets is purchase price, including import duties and other non-refundable taxes, levies, and excluding trade discounts and rebates. So purchase price, whether the purchase price, normally what we are doing, purchase price, sometimes we are adding the installation cost to the purchase, and also even freight also we are considering that into the purchase cost of the asset. And any attributable cost bringing the asset to its working condition or its for its intended. You have bought some machinery and you have placed that you have brought you brought those machineries into the factory. You have to install it, then you have to perform it, and installation cost you have to add. So that is whether those things have been included in the cost of the fixed assets. So the another thing is check whether the following fixed assets been eliminated in the financial. That means the following are not essential to be included in the financial. That means one asset you are disposed of that should not form part of the fixed asset, and those from which no further benefit is expected from use and disposal. An asset is there, but you are not able to get any benefit out of it. That should not form part of the fixed assets. And check whether the revaluation is justified. Suppose sometimes those fixed assets have been revalued, whether those types of revaluation is justified or not, that also you have to see. Is it applied to the entire lot of assets? If not, is the selection is systematic, the basis should be disclosed properly. Check whether goodwill have been recorded only when the amount paid in. So with reference to goodwill, you can estimate the goodwill, but only when you pay the amount for the goodwill, then that will form part of the asset. Otherwise, it should not be included. That is money or money's worth, acquisition of business where consideration exceeds the value of the net assets. Because if the value, the payment exceeds 10 lakhs, value of the net asset is 8 lakhs. So remaining 2 or 2 lakhs is towards goodwill. Whether it has been paid or you have to include the same thing. Otherwise, it should not be forming part of the goodwill. Check whether any disposal or retirement of fixed assets carried at cost and resulting in a gains or loss been. Normally, we are valuing the fixed assets on WDV basis or straight line basis. And what is the WDV value and what is the amount on which you are, for which you are selling the asset? If there is anything more than the WDV value, that's a profit. Whether that same thing is being included in the profit and loss account, and in case of the value of the asset you receive is less than the WDV, it's a loss to the unit. Whether the same thing is being reflected in the P&L account, so the practice unit has to see whether the company has included those things in its profit and loss account. The effects of changes in foreign exchange rates. Someday here I'll tell. So this you can find from all the export-based units. At the time of selling the goods, you got say $1,000 at the rate of 70. Suddenly the value of the dollar goes to 75. So that means you are gaining. That is a profit. That is rate fluctuation. So indirectly AS11 says the rate fluctuation. So the foreign exchange transactions have been carried out as per the FEMA. So the transaction date, suppose if you are transferring the fund today, or if you are receiving the fund today, that is called as value date or transaction date. The transaction date, what is the rate? So the one, and the contract date rate is there. So the difference between the contract date rate and transaction date, that is the receipt of the forex, that is a profit or loss, and you can term it as currency fluctuations. Whether the following rules have been followed and the recognition of balance sheet, that is foreign currency monetary items should be shown on the closing date. So it is not opening date or midday rate. Suppose if you are closing on 31st of March, what is the closing rate of a dollar on that day? And that you have to consider as the value. And non-monetary items carried out at historical cost should be reported spot rate. A spot rate means what is the spot rate? So what is the rate today? That's all. So suppose the spot rate means if it is around by 11:30, you are finalizing it. That is called a spot rate. So non-monetary items you have to value at historical cost and should be reported. And non-monetary items carried at fair value should be reported at the rate when the valuation was done. And in case rate other than the transaction date that is sometimes not the closing date. So you are taking weekly average. So then also you can adopt a rate. A monthly average rate also you can adopt it. And as a practice unit, you have to see whether that type of rate code is reasonable or correct. That also practice unit has to see. This has got more impact on the profit because you can directly have that. I mean, you can have direct impact in the form of rate fluctuation in profit. As the net exchange difference arising on translation of items in the financial statements being recognized as income or expense for the period, except to the extent adjusted in the carrying of the fixed assets. What I want to say about today's presentation with reference to accounting standard part 1. I'll meet you on part 2 of accounting standard peer review and wish you all the best. Thank you very much for patient hearing the presentation.